Good morning, good afternoon, everyone. Welcome. Let's give everybody a few minutes to join in. And I'm always happy to see so many people show up. Let me just make sure that everything on my side is also set up. There we are. So let's give people one more minute to trickle in, and then let's get started. Yes, good afternoon, everybody. I am very happy to see everybody here. Before I introduce myself, I kind of want to set the stage here with a sample case from a client that we've encountered. And this is an e-commerce client, obviously. They've been in business for 5+ years, have had very serious, very solid revenue growth over the years. But every season, their sales are quite seasonal, they would face stockouts, they would face cash constraints, they would have all sorts of surprises that would cost them money in both in cash outs, they would lose out on revenue, and they would have sleepless nights because of the worries of, can we afford to pay the inventory? Do we have enough inventory? Can we bankroll the low season? All these kind of things kept them up at night. And on top of that, just to make things worse, the owners barely got paid because they were growing very fast. Every single dollar had to be reinvested in the business. So they were not sleeping and not getting paid. Yet, from the outside, if you looked at the P&L, their business looked pretty damn solid. It was actually a very healthy, decent, profitable, high revenue growth business. Yet the owners didn't trust the P&L because it didn't match with their feelings, and they were very, very insecure. So in the end, we helped them get in control, sleep better, and arguably that's the most important one, avoid stockouts, and at the same time improve cash flow. Now, that might sound like magic, and it's not. I'd like to pretend that it's rocket science, but it's absolutely not, and we're going to cover that today. So today, this webinar is focused for e-commerce specifically, and more specifically, those owners that really want to level up and understand and use the finances to actually grow the business. So I'm Rob. I'm the founder, one of the founders of Insight Matters. I've been an entrepreneur for 15+ years, ran different companies from 4 different countries. I have a background in finance, and I started Insight Matters in 2018 as a fractional CFO business. And over the years, we've grown. We're currently a team of 25, and we focus on helping 7- and 8-figure e-commerce owners level up their finance game. And when I say level up their finance game, I mean actually use the financials to get value and make better decisions. We do so by providing different services. We can take over the management accounting. Please note that I say management accounting, not tax accounting, because that's a whole different area. FP&A, financial planning and analysis, that's what we're going to be focusing on today, as well as the fractional CFO side. Now, before we really jump into the context, I do want to highlight a few things. One is today we're going to focus on the FP&A side. What I'm going to explain here is really how we work with our clients. It's the foundation of everything that we do. I'm not going to hide anything. We're not going to leave anything out. What I'm going to explain today sounds straightforward, and honestly, solid FP&A is pretty straightforward. So you can do this yourself. Now, we will simplify a little bit here, left and right, because we have some time constraints. And everything that what we talk about here is focused on e-commerce owners ranging between, let's say, 3 to 10 million with 1 or 2 sales channels and 5 to 10 product groups. Why that matters is very simple. FP&A needs to be the right level of complexity. If you're having No, let me put it differently. A $30 million business with one channel and one SKU is super simple, while a $1 million business with 5 channels and 70 different product groups can actually be quite complicated. So the level of complexity that you need on the FP&A side needs to match the complexity of the business. And if anything, that's lesson number 1. Keep the business as simple as possible. Less sales channels, less SKUs, make for a simpler business. And especially with inventory, less SKUs or less product groups makes it simpler. So everything I tell here today, keep in mind that that's the focus. If you are more complicated than this typical case we're talking here, you might want to add some complexity and some refinement in everything we're explaining today. If you're a little bit smaller or a little bit simpler, then simple it down, dumb it down a little bit further, because it doesn't really need to be that level. Another thing, if you have any questions, by all means, send them in the chat. Where possible, I'll cover them during the webinar. If it's not possible or not, then we'll have a separate section at the end where we'll go through all the other questions. Now, the core problem for most e-commerce businesses, it's not the goals. Most entrepreneurs have very ambitious goals, very clear vision of where they want to go. What's typically the problem on the FP&A side, on the finance side, is execution discipline. Sometimes it might be a lack of knowledge, but it's typically a lack of discipline. Typically, you have a budget, you have a plan, but it's just not being used to actually guide decisions. From my experience, it almost seems like once a year, people make a budget, make the plan, and then close the file and start running their business and start executing and never look at that file again. They just completely lose track of what the original plan was, how they were planning to achieve their goals, and get sucked up in the routine of the day. That's not necessarily wrong, but it means that the plan you made, the budget that you made, will lose relevance very, very fast. So that is why typically these growth plans fail. They're built once, and then they sit there collecting digital dust in a folder where it's never looked at. They're not connected to the operations. Maybe the owner makes a plan and to, let's say, increase revenue with 50% this year. But it doesn't cascade down, or it doesn't translate down to what the operations team needs to do, what the marketing team or marketing person needs to do. And that's probably one of the most important things for today. There's no feedback, there's no learning curve. The plan, the quality and the accuracy of the plan for this year is the same level of accuracy as it was the year before. And that's a problem, because that means last year's plan was unreliable and this year's plan is unreliable again. So there has to be a learning curve, there has to be a feedback loop to actually make that interesting and actually helpful. Now, let's clarify a few of the terms. The goal is what you're setting out to achieve. What is it that you want? That could be revenue, that could be profit, that could be personal income, but it has to be, it could be market share, but it has to be very clear. What is the goal that you're trying to achieve? The plan is where you are today. What's the road that you're going to take to get to your goal? What actions are you going to take? Which products are you going to launch? Which sales channels are you going to add? What marketing campaigns are you going to experiment with? How do you get from where you are today to that goal? And again, that could be revenue, could be profit, could be whatever it is that actually drives you. FP&A is the financial system, it's financial planning and analysis that actually that actually translates everything that happens in the business into the management reporting and to the analysis of, okay, so what actually happened and why does it matter and what's the story behind it? It's a translation of just the books with the numbers to valuable management information. So, as I mentioned, typically what happens without any form of FP&A in place, there's no feedback, there's no learning, and there's no progress in that sense. So you as the owner keep driving blind. And that's unfortunate and absolutely unnecessary because, again, it's not rocket science. Budgets and plans are connected, and typically why the budgets fail is similar to why plans fail, because they are static, they are dormant, they are disconnected from decisions, and there's no review rhythm. Now, if you want to change that, and this is where we're going to explain how we approach FP&A for all our e-commerce clients. Once you have an idea, this is my goal, the first thing is to actually build that plan. And I'm pretty sure that on the marketing side and on the operations side, you have a very, very clear angle of how to actually build that plan. On the financial side, it might be a little bit more unfamiliar. So there's a couple of steps here that you want to take. The first thing is sales, and specifically units per product group. How many do you plan to sell? If you have 5 SKUs, for each of those 5 on a per month basis, what do you plan to sell there? And the reason why you start with sales is because that's going to translate into inventory, because that's going to tell you what your inventory numbers are per SKU or per product group. If you have that, you also know, given your suppliers, given your lead times, when do you need to start ordering inventory? If you know when to have to start ordering inventory, you also know what your payment terms are going to be towards your suppliers. Then your operating expenses, your marketing, your team, your travel, all of those are pretty easy to forecast typically. And then all of that culminates into a cash flow forecast, or a cash flow plan, actually. That sounds quite abstract. This is what it actually looks like. If we forecast for our clients, and yes, we use Excel because it's very important that this is manual, because it actually forces you to think about what you're going to do. The thing here is you start by forecasting the units. How many shirts, how many leggings, how many bracelets, whatever it is that your products are. At the pricing point, you can add as much complexity or as much units or as much product groups as you want. But again, a simpler business has less product groups, makes it easier to forecast. You also have less suppliers to worry about. If you then translate that, and I'll share you this model in a second, you translate all of those assumptions on your sales forecast, your numbers, your unit cost, your revenue per unit, and your volume of units. That translates into revenue. As you can tell here, these numbers are very low. This is a placeholders just to show how the model works. When you cascade that down, you have your sales per units and you have your cost, your gross profit, etc. There's a whole financial statement behind this in the model. The most important thing here is, again, is the translation into cash flow. When you start with sales per units, you know your inventory units, you know when you're going to have to order inventory. And again, the reason why I'm emphasizing that to do this manual is your actions on the marketing side will impact your sales forecast. It's very typical that people would just forecast we're going to double our sales in the next quarter. And if you then look at the marketing spend or the marketing plans, there's nothing in there that would actually give a reason to believe why they actually can double their sales. If you're using an automated tool and you're saying these are the forecasts of the volume and these are the expenses, that connection between what actions are you going to take and what results do you expect from that, that's missing. So I know it is a bit labor intensive, but it is very, very important that you think this through. What are you going to do? What actions are you going to take? Where are you going to spend time? Where are you going to spend money to realize which sales? If you want to grab a copy of this model, here's the QR code, scan it. It will take you directly to a Google Sheets. Make a copy of the file, and you can already start working on that yourself. Now, for this to work in a proper FP&A setting, a couple of things need to be true. One, and I know this is not very sexy, but it is so incredibly important, you need clean and accurate books. Typically, management accounting or accounting in general is considered an afterthought, but it is so important. It's the foundation of the finance function. But anything that happens on the FP&A side, anything that happens on the CFO side, and ideally anything that happens with you on the owner side, relies on very accurate management accounts. So clean books is not negotiable. Timely data. If you're going to run FP&A in a proper way, and it is, let's say, end of February, by the time you get your December books, it's absolutely useless. It's going to take, if you look at the results, then you want to make changes and measure those changes and see the results again, you're again months down the road. So for this to be effective, data needs to be timely. If you get your financials and your analysis within the first, let's say, 10 business days of the new month, you still have 20 days of the month to take corrective actions. And then it's before, let's say, the 10th of the next month before you already see the impact of those actions, and you can fine tune again and iterate again. So that whole feedback cycle gets shorter. So timely data, absolutely critical here as well. The third one is the structure, like the breakdown, the categories in your financial model, in the template that we just shared, has to be exactly the same as in your QBO or your zero. If they don't align, your forecast and your actuals are absolutely impossible to compare. So they have to be the same structure, whether that is by product group, by country, by marketplace, whatever breakdown you decide is the most relevant for you, they have to align. The model you're forecasting and the actuals you get from your accounting team have to be in exactly the same format. And finally, the owner discipline. It is really, really important that you as the owner do this consistently on a monthly basis. If you do this now and you build this up, and then it's going to be 3 months before you look at it again, there's not much learning going on there. So that feedback cycle requires your discipline. Now, you might ask, I spent a lot of money, a lot of time building this plan. I have my marketing plan. Now what? So what? How do I actually get value from this? Because the model alone doesn't really create value. It's a good thinking exercise, and I think that is very, very important. But where the value is what you do after you actually build the model. That's the magic sauce. The FP&A control loop. And we've already covered the plan because that's where it starts. Then the next step is you get the actuals from your accounting team, from your bookkeeper, your accountant. I hope you're not doing it yourself. You have then two very important pieces of data. Where the value starts to come is the variance analysis. You look at what did we forecast and what actually happened. We forecasted we're going to sell 5,000 leggings. We sold 4,000. That's something you want to flag. And then comes the learn step, and I'll go through that in a bit more detail in a second. Learning means understanding why things happened. Why were you off? Was it a stock out? Did the market not respond? Was there a holiday? What caused your difference? And then adjust. And this is where it gets important. You want to update your plans. So the first time you're going to make a plan, you will be off, and probably by a lot. And that's fine. That's not a problem. The whole purpose of this FP&A is that you learn and adjust and learn and adjust so that over time you get more accurate. The first time you make this plan, your sales might be off by 30, 40, 50%, and you might feel you have no levers to actually control how you're dealing with it. I can tell you from experience, if you run this and you iterate on this on a monthly basis and you actually spend the time to go through this and review and iterate, you're going to get more and more accurate. We have clients now that forecast their sales and their cash position within, let's say, 5% accuracy. And I think it's pretty obvious to understand, if your forecast is off by 30%, you're going to need a lot more inventory and therefore a lot more cash to actually make sure you have enough. While if your forecast is within 5%, you can be much leaner on the inventory side. You can be much more accurate and diligent with your marketing spend. It's easier to say, I'm going to add oil to the fire, or I'm going to take back a little bit. If there is a supply chain disruption, you know exactly how much you want to scale back your ads to not run out. So that whole process of getting more accurate, that is by far the most important part here. So if you're going to talk about how to actually run that variance analysis, there's different ways you can do that. The easiest way is, if your forecast and your books line up, upload your budgets, upload that forecast into QBO or Xero, whatever you're using. In QBO, there is a report, a standard report called budgets versus actuals. In Xero, they call it budget variance. It looks like this. This is the easiest and the simplest way to actually see what is the difference between what we were planning to do and what actually happened. And this is an example, obviously anonymized, from a client of ours. Their sales was 3% over budgeted this month. That is very, very nice and accurate. Now you will see here that the gross profit is insanely high compared to the revenue. This is a digital product clients, but I wanted to show this because they are so accurate in their revenue forecast. This is all the data you need, but this is not very intuitive or not very easy to read for a lot of people, because it looks like a wall of numbers. So what we typically do is we make it into an interactive dashboard. We use Power BI. You could use any visualization tool that you want. There's a couple of things here why I think this is way superior. One is it's visual, so it's easier to see the conclusions rather than a wall of numbers. Second is, if you're using a proper tool, you can slice and dice the data and play around with the data to actually get more granular data. This is overall revenue, but with the proper tools, you can do this also on the revenue per sales channel or your revenue per product group, making this even more helpful to actually see. The second part is, in that wall of numbers from the last report, it's exact same data, but it's very, very hard to distinguish trends. Well, in a visualization like this, you will easily see, hey, your actuals are consistently below target. And in December, there is a quite big dip. This also seems to be less intimidating than a wall of numbers. Now, if we talk about how does this review session or meeting work? Worst case, you do it alone. That's okay. Ideally, you do it with your co-founder, your controller, your CFO, somebody to bounce ideas off and actually ask questions and iterate. Because simply put, two people know more and see more than one. But the first question you're asking is, what's the delta? What's the difference? If you're forecasting 100,000 in sales and you're doing 100,050, there's a $50 gap. That's not material, it's not relevant. Don't waste time on it. So you're looking at where is the gap material? Where is it big? The easiest way to define that, of course, is percentages. And if we go to this one, here you see where the percentages changes. So for example, here there is one where the gap is 236%. So the sales are 2.5 times the budget. That's something you want to dive into. The second part is, where are the numbers like materially different? Even though the percentage might be small, if the dollar amount is high, it's still something you want to understand. Second, probably the most important question is, why is it different? And there's no judgment there on whose fault it is. This is really about understanding the root cause. What led to the difference? Is it the marketing? Is it the sales? Is it the product? Is it the logistics? Is it whatever it is? Understand the root cause. Because if you understand the root cause, then the question becomes, what can you do about it? What levers can you pull to change course, to correct course? If your ad funnel is not converting anymore, and you identify that that's the issue, you can test new ads. But if that same result is, and the ad funnel is working, but there is a burden, like a hurdle on the checkout page that drops conversions, then maybe that's where you're gonna look at, where is the issue? What can we do about it? And fourth and finally is, take these learnings, update the plans, and adjust your forecast. So if you realize that your paid funnel is not delivering, maybe the next 2 months you want to add extra budget and make an extra reservation or an extra investment in testing new funnels, testing new creatives. So you're going to forecast a higher ad spend, and that hopefully will actually translate into the appropriate revenue. But it is this process of, what's the difference? Where does it come from? What levers can I pull? And let's update the forecast. That is the core of the FP&A cycle. And I want to dive a little bit deeper into the understanding the why. Why is it different part? For example, and this is a little bit analytical or a little bit logical thinking, but it is, let's say the revenue is off. So you want to break that down into what drives revenue. That's basically, and there's different ways you can define it, but in this example, revenue is nothing more than the number of orders that you have times your average order value. So if your revenue is off, you want to look at, is the number of orders down, or up, or is the average order value different than the expectation? In reality, probably both, but one of them is going to be off more than the other. If your number of orders is down, is it the number of recurring orders from recurring clients that is down, or is it different, or is it the number of new customers different than the forecast? Because that has a different root cause. If it's recurring customers, what happened on retention marketing? Is there any change there? If the number of new customers is the big delta, where is that coming from? Is that the ads, assuming you have a paid funnel, Is the ad spend different? Is the conversion rate different? Really go down logically every step, breaking down what are the key drivers. Same for the average order value. Is it the average revenue per product down or different? Or is the number of products in the basket down? So again, break that down, very logical to understand which key point is the driver. And again, the first few times you do this, everything is going to be off, and you don't want to drown in trying to fix everything. You want to start with where is the biggest difference? Which one has the biggest impact? If your number of items per cart went down from 2.1 to 2.0, but your conversion rate went from 20 to 10%, you know that that's the one, the conversion rate is the one where you want to start looking. So in a recap, what we know now, it's not the goal that is the problem. It's rarely ever that there's a goal that is too ambitious. There might be a problem with the plan, because if you're having a very ambitious goal, you need to have a very aggressive plan. So typically, if the plan is not realistic, you're not going to hit your goal. So typically the plan and the goal are not the problem, but the road just needs refinement. You need the structure, the system, and the discipline to actually make sure that what you're planning to do is actually going to result. And again, I can't emphasize this enough. The first few times you're going to be wildly off, and that's going to hurt. Nothing is more frustrating than making a plan and completely missing it. But the more you iterate, and this is where the discipline comes in, the more you iterate, the more accurate you will get. And then you're going to be in a situation where you have an accurate plan, no surprises, no stockouts, no missed revenue, and you're going to have significantly higher profit, more cash in the bank, and if you're looking for an exit, a higher valuation. It's not rocket science, it's simple systems and discipline. Any questions? I see one. So my books are not really clean. Do I need to fix all of that before I start planning? Not necessarily. Getting your books clean is very important. Closing off, in this case, 2025 is priority number one on that part. But you want to make sure that your books as of 2026 are going to be in better shape. You don't have to wait to get clean books so that you can plan. Early in the year, do both simultaneously, and make sure you communicate with your bookkeeper or accountant that on what you're planning to do and what the structure of the books needs to be for it to be actually be useful for you. FP&A business growing 50% per year right now, updating my forecast quarterly. Should I be doing this monthly? Ideally, in a perfect world, you have an annual forecast that you revise quarterly. In the beginning, it's all about that learning curve and doing the iterations, getting the muscle memory and getting your ropes in, basically. So in the beginning, yes, do it monthly, because the more iterations, the more feedback, the faster you're going to get it to a level of accuracy. The thing is, our revenue is pretty volatile. How do you even plan for that kind of uncertainty? So hopefully, if you understand why is it volatile, is it just seasonality? Let's say you sell beachwear, then you can forecast your seasonality quite a bit. The thing is, we've had a couple of clients where when we started, sales looked very erratic and very volatile. But if you start digging in, you realize that some of that was real seasonality, which I'm assuming is the case in your case as well. And part of it is the consequences of stockouts, Facebook ads that were blocked, or other things that were not normal operations and therefore skew the data. So ideally, you have an idea on what is the issue. From what you've seen, what's the biggest budgeting mistake founders make? Ooh, I don't want to guilt or shame anybody, but typically founders are way too optimistic. They believe they can double their business with very limited marketing spend. So, or they can do 5 times the amount of volume without hiring anybody. So the link between what it actually takes to get something done and the results is typically the problem. And I'm guilty of that myself. In my first business, the forecast was that I was supposed to have basically a Caribbean island by now, because sure, we can build this business, we can realize the sales, and we're going to make millions. Reality is, it's never that easy. Things always take longer or are more difficult, or typically more difficult than you would expect. I'm a bit confused about ownership. Who should basically build the budget? Is that the owner? That depends. This is where your size and complexity comes in. If you're 1 to 3 million in revenue, it will probably sit with you as the owner, simply because you are the expert. You know your business, you know your market, your marketing, your product, your supply chain better than anybody else. That doesn't mean that you should be doing the books, because please don't. But running the forecast, making the strategic plan, and building out the forecast is probably still with you. You can have people help you with that. A controller, a good accountant can really help you with that, but the ownership of that lies with you. Once you get to, again, depends on complexity, over, let's say, 15, 20 million, and you have a management team, at that point, your fractional CFO, your in-house CFO, your fractional controller, whatever it is that runs the finance, that person should own that process. And you still set the direction, but the actual ownership of making the plan no longer sits with you. And in the group we're talking about here, let's say between 3 and 10 million, the ownership shifts. Depending on ownership, on complexity and your level of comfort and the strength and the quality of the person who you would delegate it to, it's a joint exercise where one of the two sides is a bit more in the lead. And I think we have time for one more. I hear budgeting and FP&A mentioned all together all the time. What's the actual difference? So they're interconnected. Financial planning is basically making a budget and owning the analysis of it. The budget is, of course, the financial part and the business part. The FP&A, financial planning and analysis, is the process of reviewing those plans and actually analyzing what happened, where the variances is, translating that back to the business, or in most cases the owner, and then figuring out what the iteration is. The FP&A person or team will never own the implementation of those changes, but they are the ones who are flagging it. So it is where the owner and the finance person or the finance team really join together. I want to ask, all founders want to be optimistic about their business. How can you ask calibrating questions to pull them back without touching their confidence? The way I like to do that is really asking, what does this take? And what steps, like what evidence do we have that this might, or what indications do we have that this is going to be as easy or as successful as you would expect? If a founder is forecasting doubling the revenue with no extra spend, I'm sorry, that's easy to call them out. That's very optimistic, if not a little bit naive. But it's really poking them on the questions. What does this take? How do we plan to do that? If you plan to run 7 new product launches, who is actually going to do that? What are those people doing now? It's really trying to help them break it down into more granular part. Okay, let's do 2 more. Realistically speaking, how long should it take to build a full financial plan? All of it. That, again, depends on complexity. If you take the model that we shared here, and you tailor that with your products and your channels, and if you don't have too many of those, filling that out and thinking about it is probably 1 or 2 hours. If you have a lot more complexity, or you have a lot more aggressive plans or a lot more uncertainties, then it might take a little bit longer. And I understand that is a little bit scary because of course that's a lot of time, but it is really worthwhile because it's going to prevent you from making a couple of really, really expensive mistakes. And finally, maybe a basic question: how do I choose the right KPIs for my business model? For e-commerce, actually, we have an article about that on our website. There's a range of default e-commerce KPIs. And you're talking about revenue, gross margin, operating cash flow, and there's a couple of inventory-related ones. Here too, like a lot of things here in the FP&A part, it's 80-20. 80% of the e-commerce metrics are applicable. 20% will be very specific to your business on the channels you use, the audience you service, etc. For example, if you're having a lot of subscription clients and you have a very high repurchase rate, the relative importance of acquisition cost goes down a little bit. Or you're going to put a little bit less emphasis on some of the lead gen metrics because retention is so much more important in your case. If you really want to know, I'll send an email to you later with the link to the article, because that lays it out in a lot more detail. Then one final note: if you want to have a conversation with us on how we can help you set it up or manage or get more value from the FP&A, schedule a call, use the link, scan the QR code. That's the way we work. It's very much focused on trust and reputation. So that's not a hard sales call. That is really just a conversation of how can we help you get the most value from your books, from your numbers, so that you can actually make 2026 the first year you're going to actually hit your goals. For now, thank you guys for joining. I hope it was useful, and I'm looking forward to talk to you guys soon.